This is Chapter 12, which deals with partnerships. This is Part 1 of Chapter 12, Partnerships. The learning objectives are: 1. Identify the characteristics and types of partnerships. 2. Account for the startup of a partnership and prepare partnership financial statements. 3. Allocate profits and losses to the partners. 4. Account for the admission of a new partner. 5. Account for a partner's withdrawal from the partnership. And 6. Account for the liquidation of a partnership. Let's begin with learning objective 12.1. Identify the characteristics and types of partnerships. So what are the characteristics and types of partnership? First of all, what is a partnership? A partnership is a business with two or more owners that is not organized as a corporation. Now, many businesses are organized as partnerships because of the characteristics that are common to this type of entity. Partnership characteristics provide some unique advantages and also disadvantages over the sole proprietorship and corporate organizational formats. Some characteristics of partnership include a written agreement, limited life, mutual agency, unlimited liability, co-ownership of property, no partnership income tax, and partners' capital accounts. What is the written agreement? A partnership is somewhat like a marriage. To be successful, the partners must cooperate. But the partners don't vow to remain together for life. To increase the partners' understanding of how the business is run, they should draw up a written partnership agreement, also called the Articles of Partnership. The partnership agreement is the contract between the partners that specifies such items as the name, the location, the nature of the business, capital contribution, and duties of each partner. And also, they should include the method of sharing profits and losses among the partners. Now, this agreement is a contract between the partners and it is governed by contract law. The partnership agreement outlines the rules of the partnership. The Articles of Partnership should specify the following information that you see there: the name, the location, the nature of the business, name, capital contribution, and duties of each partner, procedures for admitting a new partner, method of sharing profits and losses among the partners, procedures for withdrawal of assets by the partners, procedures for withdrawal of a partner from the partnership, and procedures for liquidating the partnership, selling the assets, or paying the liabilities, and giving any remaining cash to the partners. A partnership has a limited life. Any changes in the existing partners, whether someone withdraws or dies or a new partner is added, causes the old partnership to dissolve. Dissolution is the ending of a partnership. The addition of a new partner dissolves the old partnership, but it creates a new partnership. Mutual agency. Mutual agency means that every partner can bind the business to a contract within the scope of the partnership's regular business operations. For example, if Sheena Bright, a partner in the firm of Bright and Gonzalez, contracts to borrow cash, and then the firm Bright and Gonzalez not just Bright, owes the liability. However, if Bright signs a contract to buy her own personal car, not to be used in partnership, the partnership is not liable because it is a personal matter for Bright. With unlimited personal liability, when a partnership or a sole proprietorship cannot pay its debts with business assets, the partner or the partners or the proprietor must use personal assets to meet the debt. Each partner has unlimited liability for the business's debts. If either partner can't pay his or her part of the debt, the other partner must pay the total. Co-ownership of property. Any asset contributed by a partner becomes property of the partnership. The partner who contributed the property is no longer the sole owner of the property. Any new assets purchased by the partnership are owned by the partners. A partnership pays no business income tax. Instead, the net income of the business flows through and becomes taxable income of the individual partners. The firm pays no income tax as a business entity. Suppose that Bright and Gonzalez firm earned net income of $200,000, shared equally by the partners. Sheena Bright and Martin Gonzalez each pay personal income tax on the $100,000. And that is the $200,000 divided by the two of them of partnership income. Accounting for a partnership is much like accounting for a sole proprietorship. Because a partnership has more than one partner or owner, each partner needs a separate capital account. For example, the equity account for Sheena Bright is Bright Capital. Similarly, each partner has a withdrawal account, such as Bright Withdrawals. Here you see in Exhibit 12-1. It lists some of the advantages and disadvantages of partnership compared with sole proprietorship and corporations. Now, most features of a sole proprietorship also apply to a partnership. For example, limited life, unlimited liability, and no business income tax. So here you see with the partnership advantages, you see versus the sole proprietorship, partnership can raise more capital. Partnership brings together the abilities of more than one person. Partners working well together can add more value than by working alone. Now, some of the disadvantages is that partnership agreement may be difficult to formulate, and each time a new partner is admitted or a partner withdraws, the business needs a new partnership agreement. Relations among partners may be fragile, and another disadvantage is that mutual agency and unlimited liability create personal obligation for each partner. The partnership versus corporation. Partnership is less expensive to organize than a corporation, which requires, of course, a charter from the state with a corporation, and there's no double taxation. Partnership income is taxed only to the partners as individuals. A general partnership is a basic form of partnership. Each partner is a co-owner of the business with all the privileges and risk of ownership. The profits and losses of the partnership pass through to the partners, who then pay personal income tax on their share of the income. A limited partnership, or LP, has at least two classes of partners. There must be at least one general partner who takes primary responsibility and usually operates a business. The general partner has unlimited personal liability and therefore takes most of the risk if the partnership goes bankrupt. Usually, the general partner is the last owner to receive a share of profits and losses, but the general partner often gets all the excess profit after the limited partners get their share of the income. A limited partner is usually an investor who does not participate in the day-to-day operations of the partnership and has limited personal liability for partnership debts. Now, limited partners have no personal liability for the debts of the partnership beyond their contribution in the business. The limited partner, they usually have first claim to profits and losses, but only up to a certain limit. In exchange for their limited liability, their potential for profits is also limited. A variation of a limited partnership is the limited liability partnership, or LLP. Now, this type of partnership is designed to protect partners from the malpractice or negligence of another partner's action. In an LLP, each partner is not personally liable for the malpractice committed by another partner. In most states, however, each partner is still personally liable for other business debts. LLPs must carry large insurance policies to protect the public in case the partnership is found guilty of malpractice. Medical, accounting, legal, and other professional firms are often organized as LLPs. LLC, Limited Liability Company. LLC is its own form of business organization, neither a partnership nor a corporation. It combines the advantages of both. The LLC form is perhaps the most flexible way to organize a business because the owners or members, they're sometimes called, they have numerous choices. The features of a limited liability company that parallel a corporation are: the LLC is a legal entity that requires the business to file articles of organization with the state. The business name must include LLC or a similar designation to alert the public about the limited liability of the members. The members are not personally liable for the business debt. Now, the features of an LLC that are similar to a partnership are: one, the LLC can elect not to pay business income tax. The income of the LLC can be taxed to the members as though they were partners. The members can participate actively in the management of the business, and the accounting for an LLC generally follows a pattern for a partnership. An S corporation is a corporation with 100 or fewer stockholders that can elect to be taxed as a partnership. An S corporation offers its owners the benefits of a corporation: no personal liability for business debt, and of a partnership, no double taxation. An S corporation pays no corporate income tax. Instead, the corporation's income flows through to the stockholders who pay personal income tax on their share of the S corporation's income. Here you see in Exhibit 12-2 the different types of business organization. You have your sole proprietorship, partnership, LLC, S corporation, and C corporation. At the end of part 1 with chapter 12, partnership. Please look out for the next video, part 2 of partnership.